Good morning, everyone, and thank you for joining us for this webinar this morning, which is to give you a general update on some key recent policy developments and a comprehensive review of the recent developments, particularly with respect to FASEA and the Royal Commission. So yes, the key issues to cover today: Royal Commission, FASEA. Also, I want to take you through the insurance changes that start from the 1st of July this year. These are changes that have come out of the Protecting Your Super package, but it is important for financial advisors because this will, in most probability, impact your clients, and you might probably have already seen some letters being sent from super funds to your members, to your clients. We'll also cover off the federal election, which is an important part of the political landscape. And now that we're in May, it's just a matter of a couple of weeks before we actually see an outcome from the Australian public. And that will give us clarity as to what we might see going forward in terms of the policies being pursued by a new government. Okay, let me start with talking about the Royal Commission. The picture here shows the day that the final report was handed over from the Commissioner to the Treasurer, Josh Frydenberg. And look, the practical reality of the Royal Commission is it set in process some fundamental reforms and the demand for further changes. That certainly was kicked off by the Royal Commissioner, and the government has also responded by taking a set of actions. Let's also look at the work that the AFA has done on this. We have a page on our website. If you go onto the afa.asn.au website, click under Advocacy, there's a page there on the Royal Commission. What you'll find on that page is not only all the submissions that we did last year, you'll find the final report. You'll also find what we've done since. So the analysis documents that we've produced this year that talk to some of the recommendations and some of the issues that we've found with those recommendations. We've also seen, as the government has started to move certain reforms and put draft legislation out or put consultation papers out, we've had the opportunity to respond. And to this point, to respond to the government's proposed legislation on changing grandfathered commissions. We've now done a total of 4 submissions, and they are all available on the website for you to have a look at. Right, if I can take you back to the 6 general rules that came out of the final report. Now, I think some of these are straightforward and completely reasonable. The law must be applied and its application enforced. There's one about industry codes and making breaches of industry codes breaches of the law, which we're not so sure about. Financial products and hawking, obviously we're strongly in agreement with this, that financial products should not be hawked to retail clients. And obviously that's something that we've seen in the direct insurance space that's caused us a lot of concern. Intermediaries should act only on behalf of and the interests of the party who pays the intermediary. We have a fundamental concern about this, particularly in the insurance space, where advisors are paid by the product providers, by the life insurers, but they absolutely work in the best interest of their clients. And also the exception to the ban on conflicted remuneration should be eliminated. Exemptions should be eliminated. What we've said is that where the exemptions to the ban on conflicted remuneration, such as life insurance, work in the best interests of clients, then there's certainly no grounds to eliminate those exemptions. And obviously culture and governance practices remain particularly important going forward. Now, what I should say at the outset is that, yes, we have said some things about the Royal Commission, but there's been very little other feedback of any negative nature. So it was quite surprising when we had the former chair of ASIC come out and make a statement that he thought that some of the work of the Royal Commission was absolute rubbish. Greg Medcraft is now working in Paris. He's overseas, and it's probably a little bit easier to be highly critical from overseas. But this was quite a remarkable statement in the Fin Review quite recently. And he also narrowed in on the issue of the recommendation to ban commissions for mortgage brokers, suggesting that that was absolute rubbish and would curb competition and therefore have negative consequences as a result. Now, I want to come back to this point about mortgage broking commissions a little later on in the presentation. We do have some questions that we've received already, and what we would encourage people to do is send their questions in. I've got with me Angela Karras and Connor Weimer, who are going to help me with putting those questions to me. Now, guys, where do the participants need to put their questions?
If the participants could just submit their questions to the Q&A section at the bottom of their screen, that'd be preferable, Phil.
Thank you, Connor. And Connor will stop us at various points in time to put any questions forward. So we encourage you to do that. We're not going to wait till the end. We'll choose sensible times to stop and cover the questions that are put forward. Okay, so there were 10 key recommendations in the financial advice section of the Royal Commission final report, and there was another one later on in the report that was also very important for us. So recommendation 2.1 is about annual renewal and payments, and we'll talk about that in more detail in a moment. 2.2 is about the need for financial advisors to disclose to clients the reasons why they may not be independent. 2.3 is about a broader review in 3 years' time of measures to improve the quality of advice and whether they have been effective and whether more needs to be done. In the conflicted remuneration space, 2.4 was a recommendation to ban grandfathered commissions. 2.5 was a recommendation with respect to life insurance commissions, which was not to suggest an immediate ban, but to support the ASIC review in 2021, and we'll talk more about that in a moment. 2.6 was about a suggestion to review the existing exemptions for general insurance and consumer credit insurance, but also to have a look at the non-monetary benefits that are currently available to financial advisors and licensees. 2.7 is about reference checking, which we would support. 2.8 about reporting compliance concerns. 2.9 about dealing with misconduct. And 2.10 is about a new disciplinary system, talking about a single central disciplinary body. 7.1 is compensation schemes of last resort. And I do want to talk about that more today because we've already started to see some action happen in that place. And the consequences of this can be particularly important in terms of claims made, but also the increased cost of PI insurance. So let's talk now about the implications. And look, I'm not going to hold back in the sense that some of these recommendations are going to have very significant implications for financial advice. It's most important that I think everyone's aware of how these things are playing out and what the potential consequences are. Now, if we go through them, ongoing fee arrangements, the recommendation for an annual renewal by clients is going to have a significant implication. Now, that's also potentially, it gets worse when the suggestion is coming forward that client renewal is also a process to be done by super funds. And they would no longer rely upon the renewal process that is done by financial advisors. The ban of grandfathered commissions, what we've got at the moment is the government having put forward legislation and draft regulations to ban it by the 1st of January 2021. But the ALP wants to ban grandfathered commissions from the end of this year. Now that will have a big impact in terms of revenue for a lot of practices. For some, it'll have no or little impact. But the other flow-on consequence of it is that volume bonuses that are currently paid from product providers to licensees will also become invalid, and that will certainly have a flow-on impact for licensees, where their revenue will fall, and as a result, they'll need to push up licensee fees for advisors. Life insurance commissions, there's no immediate impact, although it is very clear to us that the 2021 review by ASIC is going to be critically important, and we need to be well prepared for that to ensure the best chance of achieving a sensible outcome there. With complaints, the big issue here is that the government has chosen to make a window available during the course of the 2019-20 financial year for old complaints to be submitted. We also have a recommendation from the ALP to quadruple the compensation cap. Business costs, the removal of volume bonuses will start to have a result in terms of increased licensee fees, and I think there's some evidence of that already starting. But also we're going to see an increase in business costs as a result of the red tape that comes from the additional duplicative requirements to get clients to renew. Now, lastly, business valuations. I think it's important to talk about this because not only do we have the issue of the multiples being attributed to grandfathered commissions having declined substantially and in some cases going to zero, we also have the impact that the other recommendations have had on the multiples that apply to other lines of business, whether that's advisor service fees or life insurance commissions. And with some licensees that have buyer of last resort arrangements, there is also a flow-on consequence of this, where some of those benefits may be in question, or they may already be in the process of being reviewed or reduced. So all up, there are some fairly significant implications from the Royal Commission that we need to be very well aware of. Now, in terms of the first key recommendation, annual renewal and payment, this was a recommendation that suggested that clients should be required to renew on an annual basis. At the moment, it's only every second year, and it only applies to clients who are post-FOFA or post-1 July 2013 clients. So we are talking here about a significant expansion of what may be required. The suggestion from the Royal Commission was there should be a record in writing each year of the services that the client will receive in the next year and the total fees that will be charged. There's also an assertion that product providers would need to obtain the client's express written authority in order for the ongoing fees to continue to be paid. Now, we certainly initially interpreted that it would be a process that was pursued by the financial advisor, and that they could make that available to the product provider as proof. We've seen some evidence to suggest that maybe there's a risk that product providers would pursue this process independent of the process that the advisor is following. Now, the government responded to this recommendation to say, yes, they support it, but also they would extend it to include pre-1 July 2013 clients, which would mean that both all advice clients on advisor service fee arrangements would need to be renewed, presumably on an annual basis. Now, you may have seen recently some media coverage about a letter that ASIC sent to super fund trustees. This was on the issue of oversight of fees charged to members' superannuation accounts, and it talked about the need for trustees to have processes in place to confirm the validity of these payments. Now, if I take you through some of the specific statements, trustees should consider all necessary steps to make sure that members are aware of the fees that are being deducted from their accounts. They go on to say that best practice would be for them to provide or to obtain effective consumer authorisation to charges that are being paid on that basis. So this is suggesting that they would, as product providers, need to get authorization from the clients. Second thing is oversight processes by trustees, and they talk about checking that services have actually been provided. Measures should be in place to confirm the services are being provided as agreed to by the member. You ask the question, well, how does the product provider actually know what services were agreed to be provided? Because the product provider, the super fund trustee, is not a party to the arrangement. They should not have visibility of the SOA. That would be a privacy issue. So how do they actually play a role in making sure that those services are being provided? And then we find the next sentence of particular concern. We emphasise that care needs to be taken to ensure that controls do not place undue reliance on assurances or attestations from financial advisors or other third parties, given the potential personal conflict of interest that these parties might have in the continuation of fee payments. This is quite a surprising statement, given that financial advisors and licensees are regulated entities, and it's therefore reasonable to assume that product providers as one regulated entity should be able to rely upon another regulated entity. This is certainly something that needs further discussion. All right, I might move on now to grandfathered commissions. Have there been any questions that we should cover off?
Yeah, Phil, we've got a couple. One of them is, what has been the feedback in relation to the submissions that you showed at the beginning of the presentation from the regulators? Have we had any feedback from the regulators?
So the key ones that we've done so far, and the ones that have been around for longer, is our submission with respect to the grandfathered commissions draft legislation, which we submitted on the 22nd of March. We've had a chance to talk to Treasury about that. The key message back from Treasury was that the government is absolutely determined to push this through, and that really was the core message, that we're going to have to work hard to get a more pragmatic outcome on this. Was there anything else that is worth covering now?
Just one saying, any chance that the advisor associations and life insurance can put a joint submission to government to have the life insurance commissions to remain as is even after 2021?
Yeah, so let's cover the issue of life insurance commissions in just a moment, and that's an absolutely key point. That is certainly something that we are working with the life insurers to ensure happens. So, all right, let's get into grandfathered commissions. So the Royal Commission said it quite simply: grandfathered provisions for conflicted remuneration should be repealed as soon as is reasonably practicable. The government supported that. They set a proposed deadline of 1 January 2021, and they've said that if they are still in contracts as at that date, then they would need to be rebated to clients. The government has also taken a step to commission ASIC to undertake an exercise of oversight of the progressive removal of grandfathered commissions from the 1st of July this year, and I'll talk more about that in a moment. Now, the approach that the government's taking is to ban the payment and receipt of benefits that would be treated as grandfathered from the 1st of January 2021. They've also, in the draft legislation, done this by repealing from the 1st of January 2021 the sections 1528 to 1531 that actually facilitate grandfathering. And they've also then gone on to require that all grandfathered commissions still in force as at 1 January 2021 need to be rebated to clients. So they're saying that the product provider would not be able to pay the advisor, but instead they would have to rebate it to the client. And when you look at this, there's one part of it which is the actual commission itself. The other part is the volume bonuses. And they put in place two arrangements. One is where it's directly related to an individual to pay that, or where it relates to a group of people to do it through another mechanism. But the intent is that all of those grandfathered benefits would flow through to clients. Now, as part of this, they've also made some other key proposals in this draft legislation. One is the removal of all references that are currently in that section of the Corps Act to the acquisition of property on other than just terms. And the second one that is equally important is that they have said that Section 1350 of the Corporations Act, which is a Corporations Act requirement around paying compensation for the acquisition of property on other than just terms. So that's quite a significant proposal as part of this legislation, because it's meaning that product providers would not be covered in terms of a Corps Act obligation to compensate advisors where a benefit has been acquired. So we can talk more about the issue of those constitutional rights and the acquisition of property on other than just terms, and I'll wait to see any further questions that flow through on that. Okay, so in our submission, and we have now done 2 submissions since the Royal Commission recommendation. We responded to the draft legislation on the 22nd of March, and then last week on the 24th of April, we also responded to draft regulations that the government had released for consultation on how a rebating scheme would actually work. Now, look, I'll say at the outset of this, we do understand that across the membership, there are some members who have no grandfathered commissions and are quite comfortable that this should be banned going forward. We have other members who don't have it, or it's not an important part of their business, but they are very conscious of the way this is being done and the impact that it will have on advisors that continue in the market. And then at the other end, we've got those who it is a much more material impact on their business, and it is a very key issue for the future viability of their business. So we're very conscious that we've got a range of different implications of this particular recommendation for people. Now, our argument is that it is clear that given the supports of all sides of government, of politics, that this is going to happen in some form, in some way, at some point. And it's about ensuring that we can argue for a more pragmatic outcome and one that ensures that clients aren't disadvantaged. So our points have been that many grandfathered commission clients are continuing to be serviced and are happy with those arrangements. There are clients who will be disadvantaged as a result of this. There are clients who simply can't be moved to another product, whether that's because of capital gains tax, exit fees, Centrelink treatment, insurance arrangements. We're very concerned about the way this issue has been repeatedly misrepresented. There was no warning that this was going to be imminently banned. The suggestions that the industry has been on notice is just not true. When the FOFA legislation was put through, it was always a prospective ban. There were no suggestions that this could be banned, and there has been no suggestions until we ran into the Royal Commission. The Royal Commission had terms of reference that included a requirement for them to assess the implications of their recommendations. Now, they just simply haven't followed that. There's been no assessment of the implications of a ban on grandfathered commissions, and we think that that's wrong. The government should have done a regulatory impact statement, and the Royal Commission should have understood and considered the implications of this. Exceptions from the conflicted REM provisions do exist, and the reality is that it's not commissions that are banned, it's conflicted remuneration. So there are a set of exemptions from those bans, and there are other circumstances where it may not apply. The conflicted remuneration provisions do not apply to wholesale clients. Neither do they apply under certain circumstances to clients who received, who who were moved into products or had products implemented on the basis of execution-only transactions. We also believe that there's grounds to argue that commissions, grandfathered commissions that are being paid for clients who are in products where they simply cannot move, that those payments do not influence the product recommended or the advice that's recommended. So all this says is that it's not that simple an issue to solve, and banning grandfathered commissions and trying to rebate it to impacted clients will be particularly difficult to achieve. So our position, and this was the position we argued through the course of 2018, was that if clients are getting service and they're in broadly competitive products, then there was no requirement for them to be moved. If we look at the other segments in this 2x2, then clearly there's a need to look more closely or to take action. And if they're not getting service, then they should be getting service. And if they're in uncompetitive legacy products, then there are deeper issues that need to be looked at, although we're conscious that there'll be a range of circumstances where moving them may simply not be possible. And that's where it comes back to things like exit fees, capital gains tax, Centrelink grandfathering, insurance, and also the cost to move. Right, now I want to just bring everyone's attention to something else that the government has done with respect to grandfathered commissions. The ASIC Act, Section 14 of the ASIC Act, gives the power to the Minister to issue directions to ASIC to undertake investigations. Now, you might find it absolutely remarkable to hear that this power has only ever been used twice in the entire life of ASIC and its predecessor. First time was in 1992. The second time that it was used was the 21st of February this year. And that was where the Treasurer has decided to instruct ASIC to oversight the removal of grandfathered commissions. So they've been told that from the commencement date, which is the 1st of July 2019, they need to oversight changing the arrangements to end grandfathered commission payments. And they also need to oversee that these benefits are being paid back to clients through a rebate. So this is a mechanism for the government to put pressure on ASIC to ensure that grandfathered commissions are removed by product providers, and they are removed in advance of the 1st of January 2021. So let's have a look at the impacts. Let's have a look at how this impacts the advisor community and where the impact is greatest. So obviously we've already seen business valuations for grandfathered commission books decline. And in fact, in many cases, the valuations that are being applied by people who play the role of assisting in acquisitions or in valuing businesses is to suggest it's gone to zero. Businesses that have borrowings that are secured as a result of the value that's attributed to grandfathered commission clients have also been impacted. And we're very conscious that if there's been an acquisition of a grandfathered commission book in recent time, or there is higher levels of gearing, that this has put those businesses at risk. And also, as we've talked about before, the removal of volume bonuses and the flow-on impact for licensees is inevitably going to increase licensee fees. Now, you might have seen in our weekly newsletters, we've talked about this issue of the impact on businesses that have loans that are secured by grandfathered commission clients. We have received feedback on that. We've gone to the Australian Banking Association, the ABA, to talk about it. And our message to the ABA is that there will be a significant impact on a material number of practices, and it may, as a result, put their businesses at risk of foreclosure, of the banks moving in and saying, well, you don't have enough security. You need to either repay the loan or put more security into the arrangement. Now, I think it's important that the ABA is aware of this. They have willingly taken the issue on, and we invite you to come back to us if you have personal circumstances where you believe that that's a material factor for you, and we can go back to the ABA and ask them to have a look at particular cases. Now, I understand that this is causing a lot of stress for many practices. We encourage you to talk to your colleagues. We encourage you to talk to the AFA, and please come back to us if you want to discuss this, or if you want us to see if we can talk to the bank or pass the message on to the ABA with respect to the bank. The AFA also offers a free counselling service through AFA Care, and we encourage you to use that if you are experiencing stress as a result of these changes. So, are there any questions that we should cover off with respect to grandfathered commissions?
Hi Phil, we have a question from Craig Yates asking if he could please explain the issue regarding the refusal to release advice received by Bill Shorten in 2011 from the Australian Government Solicitor.
Can you turn your volume off? Let's cover that off. Hi Craig, thanks for joining us. We're very conscious that on the 29th of August 2011, Bill Shorten at that time said he'd received advice from the Australian Government Solicitor that the ban on grandfathered commissions could not apply to existing business. So we thought it would be worthwhile trying to get a copy of that advice. We had that declined on the grounds of legal professional privilege, which is a legitimate avenue that is available to deny the release of those documents, in that it did reflect legal advice from a lawyer to the government as part of the development of that policy back in 2011. We tried to say, well, Bill Shorten had made that advice public and therefore it should have been released, because making the advice public removes that confidentiality that is part of legal professional privilege. But they've declined to release that, so I don't think there's anything further we can do on that.
There's one more question there, Phil, regarding previous conversations about grandfathered commissions in which they stated that property rights could not be acquired without compensation. Why is this now different?
So let me just say, I'm not a constitutional expert, but happy to talk about this issue. It's quite clear that at the time of FOFA, it was considered a key issue, and there was references in not only that media release, but in the explanatory memorandum that it was not possible to do it. That was the view at that time. There's been another High Court case since that dealt with the issue of acquisition of property rights that was defeated. And then Commissioner Hayne has just come out and scoffed at the idea that it is an issue, because he said that there is no acquisition. Well, we have a different view to that. We believe that there is an acquisition of rights, those Trail Commission rights, and in fact, the point of rebating is that those rights are being redirected to clients. So they are being acquired from advisors and redirected to clients. This is a matter that would require a High Court challenge, and there are lawyers who have different views on whether there are grounds or not. I'm not a constitutional law expert, so that's probably all I can say. All right, we might move on to life insurance commissions, and keep in mind that we did get a question before, or a comment about working across the industry. So it might be worthwhile just reading out what the Commissioner said. He said that the ASIC review relating to risk insurance and commissions that is proposed to be done in 2021 should be pursued. But as part of that, consideration should be given to further reducing the cap on commissions in respect of life risk insurance products, unless there is a clear justification for retaining those commissions, the cap should ultimately be reduced to zero. Now, the Commissioner was really focused on the issue of underinsurance. Now, I don't think that by 2021 we will see the impact, the full impact of underinsurance that we would get if a full ban was introduced. The original proposal to do a review in 2021 was to see whether there had been an improvement in the quality of advice. Now, they are different purposes. A broader review of the quality of advice and whether there's going to be an issue with underinsurance and a reflection on international practice is probably worthwhile. Now, the government came out and supported the recommendation and certainly said that they will pursue the review by ASIC in 2021. As part of their response, they also went back and referred to their previous statement, which was that if they don't see a significant improvement in the quality of advice, then they would mandate level commissions, and referred to the fact that that was the recommendation in the 2014 Financial System Inquiry. The ALP came out on the 22nd of February when they released their response to the Royal Commission final report. And they've said, yes, they will support the review by ASIC, but they've said that unlike the government, Labor will fully implement this recommendation by ensuring that ASIC considers whether there is any clear justification for retaining life insurance commissions. If there is no clear justification for retaining life insurance commissions, Labor will ban them. And I think that was a very clear message, and it was it's appropriate for us to be very conscious that there is a very material risk there, and it's why we need to ensure that we are very well prepared for the 2021 review by ASIC. Now, let's have a look at how the life insurers have responded, and this is very different to LIF because we've certainly seen a response from the life insurers. Started with Zurich when they released their research that they have undertaken with respect to clients' lack of willingness to pay for life insurance advice. So they certainly have called to retain risk commissions. MLC came out with a statement a little while later, equally supporting risk commissions. Clearview made a statement as well, and then more recently we've seen TAL join in to call for the retention of risk commissions, and we equally know that AIA is on board. So I think that the positive message that we get out of this is that the life insurers are definitely committed to retaining risk commissions. They do understand, and many of them are very reliant upon financial advisors for their flow of new business, and they will be willing to fight hard for this. And we will work with the life insurers and the other associations to ensure that we do have a very strong argument by the time of the 2021 review. Now, I want to also reflect upon the fact that ASIC have said things in the past that do highlight the concern that we currently have about the outcome of the 2021 review. So in ASIC's submission to the Royal Commission back in October last year, they made a couple of statements that are grounds for concern. Excuse me. So they referred to the fact that in 2011, they had a clear view at that time that life insurance commissions should be banned. They also talked to the fact that ASIC report 587 on direct life insurance, which was released last year, suggested that life insurance commissions should be banned. But our argument is 587 was about direct life insurance. It has no relevance to advised life insurance, so it is no basis to argue that commissions should be banned. So in terms of preparing for 2021, the landscape does suggest that this is going to be a very important fight. Now, the things that we will leverage are things like the research that Zurich did using Rice Warner that demonstrated very few clients will agree to pay what it actually costs for life insurance advice. we need to be able to articulate also that life insurance through a financial advisor delivers a much better outcome in terms of the quality of the product that's aligned to the client's needs and at a good price. There's also international experience that demonstrates that a ban on life insurance commissions does not work in the best interests of clients. Were there any questions that we should cover on life insurance?
Phil, yeah, there was one question. Does the word cap legally mean that we call first year commission, therefore renewal commission or level commission remains no matter which party is in power?
So the current law actually says that there is a cap on other than level commission. So there's no cap on level commission. Now, ASIC has the powers to set those caps, and there is a cap on both the upfront and ongoing commissions. So ASIC could, through a legitimate process, decide to change those current caps. At the moment, they're 70% upfront, 20% ongoing. We know from the 1st of January 2020, they go to 60 and 20. But ASIC does have the power to change those caps, but clearly they would need to do that on the basis of the 2021 review. All right, let's keep moving. Compensation scheme of last resort. This has been an issue that has been on the table for quite some time, and it was something that was discussed as a result of the Ramsay review that led to the creation of the Australian Financial Complaints Authority. The Royal Commission final report recommended that a compensation scheme of last resort should be set up. Now, we are aware that both the government and the opposition have supported that, but what we've been concerned about is how they've gone further. So the government has suggested that there should be a scheme put in place which would allow clients who did not manage to obtain resolution of their matters from the 1st of January 2008 to make a subsequent complaint, and for those complaints to be dealt with under the current AFCA thresholds, which includes a compensation cap of $500,000. So this is quite a material issue because AFCA works on the basis of a limitation of 6 years. So if the complaint is older than 6 years, in that the client was aware of the loss more than 6 years ago, then traditionally or historically, they would not have been able to pursue that action. Now, we also have to be conscious that the impact that this might have on professional indemnity insurance. But the ALP has gone further, and they've said that they would establish a more comprehensive retrospective scheme, that they would set it up to be independent of AFCA, and that it would be based upon the higher caps that Labor has proposed. Now, it's when you look at this, Labor has suggested that they would increase the AFCA caps by quadrupling the compensation cap for consumers and doubling the cap for small businesses. So if you look at that on the surface of it, it suggests that they would move the $500,000 cap to a $2 million cap for individuals. And obviously that would be significant in terms of the impact on professional indemnity insurance. Now, the Treasurer has also moved to enact this via issuing a directive to AFCA. Now, that directive to AFCA is for them to change their rules. Now, their rules are an agreement between their members and AFCA itself. So what they're doing is overriding that process and requiring this fundamental change. And what they're saying is that they would add an additional section to their rules that would cover complaints that are effectively complaints dating back to the 1st of January 2008. Now, the window of opportunity for making these historical complaints is from the 1st of July 2019 through to the end of June 2020. So if if these historical complaints are not submitted by the end of June 2020, then that window of opportunity would be closed off. Now, we found it quite remarkable that the government is, through this, intervening in contractual arrangements that already exist between licensees and AFCA. Okay, the last point on the Royal Commission is to talk about the impact that this has had on business valuations. Now, this is clearly not good news, and I'll deliver it in the view that it's appropriate for people to be aware of this. Advisor service fees are under threat because of the proposals around annual renewal and also other activity in that space, including from ASIC and APRA, that might impact the ability to renew ongoing arrangements. So we've seen the decline in valuations. The broad feedback is that the average is probably somewhere around 2.5 times advisor service fees now, which is down from where it was before. But there's a lot of variability based upon the age of clients and other factors. Life insurance commissions have declined as well, so come down from 2.5 to 3.5 recurring income to 2.0 to 2.8, with also an average around the 2.5 mark. Grandfathered commissions, though, have certainly been hammered, and this really plays out in terms of the time frame that they could go in. As I said, the government is setting a deadline of the 1st of January 2021, but the ALP wants to see grandfathered commissions removed by the end of the current year. So that has obviously had a very big impact on those valuations. And as I talked before, that has flow-on consequences in terms of the valuations and the impact that it has on the security that advice practices have got against those outstanding loans. Right, so that brings us to the end of the Royal Commission. Is there any other feedback? Fantastic, let's push through then. So we're now going to talk about professional standards and FASEA. So a lot of activity in the later part of last year, November, December, and then into the early part, January and February, as we saw some of the standards finalised. And we've spoken, obviously, about this issue many times, both in the roadshow and also in the regular weekly updates. I will highlight some key recent developments. So on the 24th of March, FASEA released some draft consultation on further changes to the education standard. And importantly, that included a proposal from them that they intended to recognise the 5-unit CFP. It did not refer to the 4-unit CFP, so there is still uncertainty with respect to many people who hold the CFP. On the 29th of March, the AFA made a submission to FASEA with respect to the Kaplan version of our FCHFP and also the Chartered Life Practitioner. And that submission has now been with FASEA for a month, and we've got reasonable grounds to be confident that that will proceed through the process. On the 11th of April, 2 new directors started at FASEA, and we don't know at this stage whether that's going to have any material change on the thinking at FASEA, but we'll wait to see whether there's any further announcements. The 12th of April was also the closing date for submissions from higher education providers in terms of the first tranche of applications for approval for graduate diplomas and the new bridging courses. This is going to take time. This at this stage is just the preliminary frameworks for these proposed courses, and that will play out, and hopefully later this year we will actually have formally approved bridging courses that are available and also graduate diplomas. The AFA has continued to consult with FASEA and other entities particularly in regard to the education standard, but also in the Code of Ethics, and I'll talk more about that in a moment. The legislative instruments are out there. They have released 6 legislative instruments. The education one was released on the 24th of December, but that is one that is going to continue to change as they add more approved courses. This year we've seen the exam standard released in February and the Code of Ethics standard also released on the 11th of February. They have provided also some policy statements in support of some of these legislative instruments, and we are expecting further guidance on the Code of Ethics to be released in the next month or two. Now, we do continue to get people asking questions of what the impact is on them and how they will be treated. So I will just quickly go through the end outcome in the 24th of December announcement. So if you've got a FASEA approved financial planning degree, then you will be required to do just one bridging course, which is the Code of Ethics and Code Monitoring course. If you have a relevant degree, which is based upon having 8 subjects in a relevant field, and I'll talk more about that in just a moment, then you would be required to do the 3 bridging course subjects plus another subject. However, you would have access to recognition for prior learning for the ADFP or equivalent, or for a professional designation. So if you have either one or the other, then you would only need to do the single bridging course for Code of Ethics and Code Monitoring. In the release in December, they did create a new category, which is someone who has a non-relevant degree with 4 to 7 subjects in a relevant field. Now, what they've said is you would get 1 credit for having the non-relevant degree. You would get 2 credits for having between 4 and 7 relevant subjects, which would mean you needed to do 5 further subjects to get a graduate diploma. But you would also have access to RPL for the ADFP or equivalent and a professional designation. So that meant that if you had a non-relevant degree with 4 to 7 relevant subjects, the ADFP and a professional designation, then you would only need to do 1 subject, being the FASEA Code of Ethics and Code Monitoring subject. If you have a non-relevant degree, then you're required to do a 7-subject graduate diploma, however, also having access to RPL for the ADFP or equivalent and a professional designation. And lastly, those who have no tertiary qualifications would be required to do the 8-subject graduate diploma, however, with access to RPL for the ADFP or equivalent and a professional designation. Now, we're very conscious that this model still does not adequately address experience and the CPD that has been undertaken as a result of those years of experience in the industry. Now, we continue to argue that it's appropriate for that to be recognised, and we will look to leverage any further opportunities we have to push that issue. So the definition of a relevant degree. Now, importantly, as we explain in our weekly update this week, this might be from 1 degree, it might be from more than 1 qualifications, it might also include individual subjects that you have undertaken. So whether it's the 8 subjects for a relevant degree or being in that 4 to 7 relevant subjects category, you can look at whether you have subjects at the degree level or above, so at the undergraduate degree or the master's degree or a graduate diploma. So it covers accounting, finance, banking, finance law, business law or commercial law, financial planning, including super and life insurance, economics, investments, estate law and taxation law. We do make the point that 2 of these subjects, business law and taxation law, need to be approved by the TPB. Now, we've certainly been talking to the TPB and FASEA about the need for higher education providers to go to the TPB and get their commercial law and taxation law subjects approved by the TPB. This is going to be really important so that people can get the benefit of having done that further study. So let's talk about approval of professional designations. We've covered this to some extent already. It does give people the option to get 2 credits against their previous learning. Now, as I said, FASEA have approved the 5-subject CFP, but have not said, well, they've said they intend to approve it. It hasn't been finalised yet, but they haven't said anything about the 4-subject CFP. We have made an application to FASEA with respect to the FCHFP and the CHLP, but only for the Kaplan version. We're working with Mentor to get the material we need on the older version of the FCHFP and the CHLP, and we will make that application to FASEA as soon as we possibly can. If we talk about CPD, the CPD standard is live now, so all the CPD activity that's done during the course of 2019 will need to comply with the FASEA CPD standard. You need to do 40 hours. 70% of it needs to be approved by your licensee, subject to a cap of 4 hours of professional reading. In terms of the individual categories, there's a minimum of 5 hours on technical, client care and regulatory and compliance, and 9 hours for professionalism and ethics. There are tighter requirements on who can deliver CPD. There's also a requirement that for all licensees to have prepared a CPD policy by the end of March this year, and for all advisors to have a CPD plan. Now, the new regime started from the 1st of July and it's being applied on a pro rata basis up to the point of the commencement of new CPD years. Now, whilst it's not stated in the documentation, small licensees can outsource this to education providers, and it is our understanding that you can rely upon online tools for CPD, such as is provided by Kaplan through the on-track system. Questions?
Yeah, we've received a couple of questions, Phil. So the first is, what is the definition and or example of a professional designation?
So when this idea was put forward, and it was first announced by the Minister at the AFA conference last year, he specifically referred to both the FPA's CFP and the AFA's FCHFP. But that does not preclude other professional associations from making their own applications for approval of those professional designations. And it's going to come back to going through the approval process, which was a very rigorous process where you needed to prove that your coursework had content consistent with the requirements to get 2 credits as part of the curriculum for the graduate diploma. So it's not preventing other associations from applying, and we'll simply have to wait and see how that plays out.
The next question is, when do we anticipate the first national exam to be held? How would one enrol? And also when do we think the ethics course will be released? Great.
Well, I'm going to just move on now to talk about the exam because that's perfect timing. The announcement on the exam in early February finalised the arrangements. It's going to cost $540. It's going to be 3.5 hours, including 15 minutes of reading time, 64 multi-choice questions and 6 short answer questions. The number of attempts is going to be uncapped. However, the legislative instrument includes this requirement that you cannot register until 3 months after you made your last attempt at the exam. So this will in effect force there to be very significant gaps between attempts. The content will cover legal obligations and the code of ethics, two of the core subjects that are part of the bridging course and also the graduate diploma, and also financial advice construction. Although, as we say there, we're not absolutely certain on what the content of that financial advice construction material will be, and we're waiting for further guidance on this. There will be preparation materials available and practice exams, and we know that some of the education providers are also working on practice exams, which we anticipate will become available. FASEA have said to us that the exam will be ready by June this year. They've appointed an administrator, which is a group called ACER, to develop the exam, and we do understand that that development work is well underway. June is not far off. It will obviously have to be an online registration system, but we would like to see those preparation materials made available well in advance of the exam. The intent was that the exam would be available on a 3-monthly basis this year, so that meant June, September and December. We don't know any more than that, and we'll just certainly wait and see when it comes out. But when we've spoken to FASEA, and we've spoken to them a number of times this year, and quite recently, they have confirmed that June is the time frame. The Code of Ethics, so the next question was, when is the Code of Ethics subject going to be available? Well, the high-level curriculum has been defined, but obviously the Code of Ethics subject is quite reliant on the detail in the Code of Ethics, and we're yet to see the guidance that we're wanting to see. Now, it might be opportune just to talk about the Code of Ethics. We do have some concerns, and I'll go through these. Standard 2 says you must act with integrity and in the best interest of each of your clients. And we do not have a problem with that. I mean, that's absolutely supportable. But the detail then goes on to talk about, this means that you will need to work out, and if necessary, help the client to work out what the client's objectives, financial situation, needs, interest, including long-term interests, current circumstances, and likely future circumstances are. So it's issues like long-term need, long-term interests, and likely future circumstances. We're concerned about what's required to do that and the impact that that will have on providing scaled advice and also on the cost of providing financial advice. Now, the one that we've been the most concerned about is Standard 3. You must not advise, refer, or act in any other manner where you have a conflict of interest or duty. Now, in our view, the financial advice space is one where conflicts are extensive, and the focus to this point has been on managing those conflicts, not simply avoiding them. So our pushback to FASEA was this was quite impractical. They've told us that in the guidance that they're going to release, they'll make it clearer on exactly how you'll be able to operate within these requirements, and they do not see the same concerns that we have. Standard 4, you may act for a client only with the client's free, prior and informed consent. If required in the case of an existing client, the consent should be obtained as soon as practical after this code commences. Now, we've asked the question as to where might that consent need to be obtained and how broadly is that obligation going to apply. I mean, obviously, consent is obtained every second year for clients on opt-in, but that doesn't include pre-FOFA clients, and it doesn't include life insurance clients who are also exempt from the obligations around opt-in. Moving on to a couple of the other requirements. Standard 6, you must take into account the broad effects arising from the client acting on your advice and actively consider the client's broader long-term interests and likely circumstances. And we just are concerned about how difficult it might be to understand their broader long-term interests and likely circumstances. Now, Standard 7 is about remuneration. The client must give free, prior and informed consent to all benefits you and your principal will receive in connection with acting for the client. They also talk about for existing clients needing to obtain that consent as soon as practical after this code commences. Now, as we said before, obtaining consent for continuation of ongoing advisor service fee arrangements only applies to post-vote for clients. So what would the impact be if this applied more broadly? Now, last thing to talk about in terms of FASEA and the Code of Ethics and the education standards is the issue of code monitoring. So the professional standards legislation requires that advisors belong to a code monitoring body. Now, this is supposed to kick in from the 15th of November this year, that everyone has to elect to belong to a body, and that from the 1st of January next year, that the code becomes live. Now, the AFA is working with the FPA and other professional associations in order to set up a code monitoring body. At this stage, we're uncertain as to whether the recommendation from the Royal Commission about a single central disciplinary body may impact upon how this proceeds, and we're certainly waiting for guidance on that from the government. We do have very serious concerns about the timeline. The Code of Ethics starts from the 1st of January next year, but are people going to be able to undertake the study before that commences? And for those who are thinking about the timing of sitting the exam, obviously being able to complete the legal obligation subject and the Code of Ethics subject before you actually sit the exam is the appropriate timing. And if those courses are not going to be available till next year, for those people who want to sit the exam sooner rather than later, how's that going to work out? So we will continue to advocate with government that the timing is not reasonable, and that advisors should at least have another year to complete the exam. So are there any questions on the FASEA elements of the presentation this morning?
Yes, Bill. The first is, who is coordinating the process of getting universities to go to the TPB for approval of their business and tax law subjects? Also, how does this work if you finish your degree in 2002?
So we have spoken to both the TPB and FASEA, and we've encouraged both of them to deliver clear messages to the education providers to do this. The response so far is that both of them are aware that it needs to happen. There's already been a higher level of engagement with the higher education providers, because this same exercise needed to be completed for tax practitioners. So look, we are pushing that, but it's going to, and I think individuals also have the opportunity to go back to their university and say, hey, I want you to apply to the TPB to get your course recognised. Now, there is no timing limitation. The content needs to be assessed by the TPB, but it's not like they're saying it has to be recent study. So 2002 should not necessarily be a problem to get TPB approval. They will just need to go through the process.
Another question, Phil. Have FASEA indicated when they are likely to issue sample exam questions? And just a comment, given the exam is available to sit in July, they're leaving us very late.
Yes, yes and yes. There's no indication at this stage of when the exam preparation materials will be available. And considering it is now the 1st of May and June is just a month away, the time frame is very compressed. We have no further information, and we'll just have to wait for an update from FASEA. But we know that they are working as a priority on the exam.
One further question, Phil, with regards to the Code of Ethics. What does the term free consent mean?
A good question, and I think that's where we'll be looking for the guidance to make this clear. Free has to be that it's voluntary, that they have responded to it, but further than that, I'll need to wait for guidance from FASEA. Shall we move on?
Yep.
Okay, protecting your super package. This was legislation that was first proposed by the government in the course of the release of the 2018 budget back in May of last year. Now, what they proposed at that time was that there would be a set of reforms that would impact people in super, and it predominantly with a focus on making sure that it deals with duplicate accounts and unneeded insurance. Now, there were a range of measures. Now, as it turned out, there was consultation and negotiation in the Senate that led to a revised package being passed back in February. Now, this starts from the 1st of July. For those of you who've been following this, you will potentially be aware that there was an under 25 years category, and there was a category for people who had less than 6,000, and that insurance for both of those two categories should be moved to opt-in. Now, both of those two elements were removed for the law that was passed in February. So what's left is a cap on super fees of 3% for accounts with balances less than 6,000. A ban on exit fees other than buy-sell spreads. Now, why this is important for advisors is that you may have clients who were stuck in legacy products because of exit fees. So from the 1st of July this year, you'll be able to go back and have a look at them and work out whether you can move them to modern, newer products. Now, insurance for inactive accounts. Now, this is defined as accounts where no contribution has been made or a rollover in the last 16 months. They will move to an opt-in basis. So what it means is when you get to the 16-month point, it will be turned off if they haven't elected to continue. Now, the proposal in the legislation is that warning letters will be issued at the 9, 12 and 15-month mark. But I'll come back to this in a moment, that's on a go-forward basis. How does it impact at the commencement? There will also be automatic consolidation of small account balances in inactive accounts via the ATO. So why this is really important for advisors is it is a common strategy for advisors to choose to leave clients in older super products to hold on to the insurance arrangements there. And they may have accounts where there are no contributions being made and no rollovers. And there's sufficient balance to cover premiums for a few years. Now, the issue is that these will be turned off. They will be turned off if the client doesn't elect to retain them, and that in terms of the transition arrangement, the start date is they will be turned off from the 1st of July this year. So it means if no contributions or rollovers have been made since the 1st of March last year, then they will be turned off in July. Advisors need to understand all of their clients who are impacted by this. They need to make sure that they do make that election to retain their insurance, or they make a contribution or a rollover. This is really important, and we're hearing that advisors are being notified of communication that's been going out to clients in the last couple of weeks, and that will presumably continue. Obviously, these are clients who run the risk of losing their insurance, which you have deliberately recommended that they retain. It also means that the arrangements that you have in place with those clients and potentially commissions that are being paid are also put at risk. It's something that we certainly recommend that you prioritise over the course of the next couple of months. Okay, the election. The 18th of May is the important day. The government has been behind in the polls. The most recent polling suggests that the gap is narrowing, but it would be a hard ask for them to win. In terms of which side of politics is going to give us the most supportive environment, we've seen that both sides of politics intend to come down very hard as a result of the Royal Commission final report. It seems that in some areas the ALP may be harder, particularly looking at potentially life insurance commissions and also increasing the compensation caps that apply with AFCA. We've also seen a range of other policy proposals from the ALP, including with respect to negative gearing, capital gains tax, franking credits, super contributions, including the non-concessional contribution cap and the old 10% rule, and also the treatment of family trusts. Now, it's not just about who wins in the House of Representatives, because if legislation is pushed and if it's not supported by both the major parties in the Senate, then it comes down to what the crossbenchers, how they want to vote. Now, we will be going out to members before long, encouraging you to advocate with your local member about sensible reforms and fair treatment of your clients and your practices. So questions, we have some questions that we received in advance, and let me deal with these. Will you stand with the AIOFP as a united front to tackle the pending legislative reform from the Royal Commission recommendations? Now, I think the question here is probably with respect to what the AIOFP have suggested with respect to High Court action in terms of the grandfathered commission issue and the acquisition of property on other than just terms. We've continued to argue our view that we think that there is a constitutional issue here, or at least we believe that the government needs to be open and honest with us to explain why they no longer think that that's an issue. We believe that it is something that can be used as leverage, but we're not sure that the right outcome is for the financial advisor community to take action in the High Court, which could absolutely be used as a negative against the profession, suggesting that they are simply acting in their own best interest in the pursuit of this issue. Look, we'll keep an eye on this. It's something that we keep options open going forward. But we need to see how the process plays out, firstly, in any case, and keep in mind that it may become less of an issue if the government is leveraging product providers to remove these benefits in advance of any legislative change being effective. Now, we get feedback, why can't financial advisors achieve what the mortgage brokers did? Now, I'd ask you the question, who are some of the big people that have been pursued as a result of the Royal Commission? The first one is banks. The whole approach has been to slam the banks for the things that have happened in the past. But look, financial advisors have also been the subject of intense criticism for what's happened in the past. Mortgage brokers have not been treated the same way. The mortgage broker issue is also a very different issue. As you saw with the feedback from Greg Medcraft, who talked about mortgage broking, the ban on mortgage commissions would have a detrimental impact on competition in the mortgage market, and that banks would win. So the argument there is quite different, and they do have a much stronger, clearer message. They've also been able to access significant funding to pursue that program. Next question, should financial advisors be joining the FSU? Now, this has been put forward as an argument, and obviously the FSU is the Financial Sector Union, is a very different place to be playing as opposed to what's been done in the past. At this stage, we have concerns because the public position of the FSU is that they support a ban on grandfathered commissions, and they also support a ban on life insurance commissions. So we would want to see a public statement that that position had changed. What is likely to happen after the election? Well, we'll need to wait and see the outcome of the election, but what would be highly likely is that if there was a change of government, then there would be announcements come out shortly afterwards, and you would expect to see a process of release of reform proposals and then a consultation process before any of their policies ended up in the Parliament for debate. Now, at that point, let's open it up to broader questions. Ange and Connor, what other questions do we have?
If clients are notified by the insurers and they don't act, is the advisor held responsible through no recommendation by the advisor?
I absolutely believe that the advisor cannot be held responsible for that. This is legislative change. The obligation is with the super fund to communicate. In many cases, the advisor isn't even being notified. The client has the responsibility if they want to retain it. But I don't think that changes the fact that advisors will be working hard to get the best outcome for their clients. And if they need that insurance, then steps need to be taken.
And in relation to the mortgage brokers, why did the AFA not run a campaign similar to what the MFAA did?
Okay, so I think I've probably answered that question in that the mortgage brokers had a very simple message. Ban mortgage broking commissions and you will destroy competition and you'll put business in the hands of the big banks. That resonates, it absolutely resonates. The mortgage broking industry did a fantastic job in mobilising. They had significant financial contributions from the aggregators and the small lenders. Let's keep in mind that the industry fund movement owns ME Bank. They are also reliant upon mortgage brokers. There was a lot of advocacy that happened in the background on this one. We don't have that same simple argument and we don't have that same access to funding.
Yeah, there's another question here, Phil. Has there been any further clarification around only intra-fund advice being allowed to be charged to super funds? What does this mean for ongoing advice fees that don't necessarily relate to intra-fund advice?
Right, so intra-fund advice is a advice that is provided within a super scheme where it is paid for by all members as an additional fee. So it's part of the administration fee. Now, the way it's worked out is that only some members have chosen to use that, although everyone's paying for it. Now, we have reservations, obviously, about the way that works out in terms of how it's being paid for, and you could argue that it leads to fee for no service. There's been a recent some statements recently seeking to expand what can be provided in intra-fund advice. At the moment, it is just about the arrangements within the fund, including investment options and insurance within the fund, limited to the member. This, I think, could be an area that does get more focus going forward, because clearly the industry funds probably want to broaden the types of services that can be provided.
And that's all the questions we have.
Right, okay. Well, look, let me thank you everyone for participating in the webinar. I hope you've found it useful. I am very conscious that some of the messages that I have delivered may not be very comforting. We are certainly going through a period of unprecedented challenge and reform. We appreciate the impact that this is having on members, but it is important that you are aware, that you do look at the signs of what's happening, you are talking to your colleagues, you're reading what's coming out, and also that you're reaching out for support and help where you need that. So whether that's talking to your colleagues, talking to the AFA, or if you need more specific help, reaching out to AFA Care, which is detailed on the AFA website if you do need counselling help. So I encourage you to continue to read our weekly updates. I encourage you to attend the May Roadshow for a further update. But in the meantime, if you do have additional questions or you need additional information, then please reach out to the AFA, including using our policy@afa.asn.au website email address. Thank you everyone for participating. Have a great day. Bye.